Okay, it's 4:30. I want to welcome everyone to today's webinar. And what we're going to do today is just, you're going to be subjected, apologies in advance, to my sort of stream of consciousness assessment of what's going on. And what you're going to see, and I'm going to verbalize it. I do this every single day, and I do it every single night. I do it every single morning. And this is the process that I've gone through for 38 years. I always want to sit back when the dust is settled, see what's going on, and see if there's anything that is more probable than not. And sometimes it's 50-50. You just don't know. The good news today is that I think we have a pretty binary situation where if this is bearish, then we know what should not happen and we know what is likely to happen. And so what I want to do today is go through the entire thought process that I go through. And I want to share with you, and a lot of you are subscribers or members of Alexander Trading, and you've heard this and you hear it over and over again. Some of you may be new and you're not familiar with what we do. Everything that we do, everything I do at Alexander Trading is based on price action. It's based on price action through the lens of the auction market process, which is the process that all markets follow in all time frames. It's a process of development. And they follow this process of development because of the way auction markets behave. It's like a natural law. There are certain things that auction markets are designed to do, and they do it elegantly well. And at times, for a trader, you can recognize what's going on and you can predict, dare I use that word? I don't really like that word, but it's in this instance, it fits. You can predict what is more likely than not. And what you're always trying to do is get to a situation like we're in now, where it's pretty binary, where you're at an inflection point, and there are different inflection points formed by this auction process. And that's where we want to be trading. It's where we want to be making trade decisions, because at those inflection points, you could flip a coin. If you only traded at inflection points in any given time frame, and you flipped a coin to decide the direction over a large series of trades, 100 trades, a couple hundred trades, you'd make money. Why? Because the move out of that inflection point is almost always a multiple of whatever risk you would have to assume to take the position that would invalidate the side that you took. Now, I like to think we can do better than that, and sometimes we do, sometimes we don't, but that's, in a nutshell, is what we're doing in terms of how I analyze the markets. Now, I'm going to show the market profile graph as well. It's very important for traders, especially if you're a new trader. I've been trading 38 years, and I've tried everything you've tried. Believe me, as I've said many times, I'm an expert in more nonsense than I'll ever admit to. And over the years, I use less and less stuff, because ultimately I'm trading price. I make money or I lose money by what price does. That's just a fact. So if that's the case, then I learned, it took me a long time, too long probably, to learn that I'd be far better off spending my time understanding and learning price behavior than I would be some derivative of price behavior, like the 7,000 and growing number of oscillators that are out there. So everything that we do is based on price action. It's based on pattern recognition of how, through the lens of an auction market. Now, auction market analysis sort of goes hand in hand with traditional charting analysis. There's a lot of overlap there. And I consider charting analysis to be very valid. So let's talk about today. Now, something that we look for when a market is making a move is, and this, you're looking at the 4 primary U.S. trading indices here. We're looking at the SPX. You don't see my screen. Maybe we should do that. Probably don't want to just stare at me the rest of the afternoon. Okay, now, this is helpful, I guess. What you see are the four primary U.S. trading indices: the cash markets. This is the S&P, the Index, the Russell, and the Dow. Now, when there is a move of conviction, meaning the institutions, the big money, those that comprise the big money, and if you're wondering who they are, it's not you and me. I don't care how large you trade as a retail trader, you're not the big money. The big money are the large institutions, the large hedge funds, the banks, et cetera, option dealers. And so what you're looking for when there's a move of significance, and I consider this to be a move of significance. It's a wide range move for one thing, and there are other reasons. I'll get into that in a minute as well. But what you're looking for is, are all four of these confirming the direction the market is making based on recent trade? So the question is, did all four of the indices take out the recent lows? The answer is definitely yes. Now, we flirted around in a balance area here for 2 or 3 days where some did, some didn't, et cetera. There was some flirtation with that September low before all of the indices traded below it. And now everything is in lockstep. Everything is in lockstep to the downside. That is showing you an institutional conviction that is necessary to sustain a strong move, a directional move. Now, another reason, and this is an auction market and it's a market profile reason, and I guess let's just go to the market profile chart. Let's see here. So basically, if you look at my chart, this chart, I want to go to, let's go to a 60-minute time frame. Now, this includes Globex. We'll get rid of this. So coming into the day, the last 3 days had formed a multi-day balance area. Now it's, balance areas, one of the things that you look for in market profile, actually on a bar chart as well. Again, a chart is just a reflection of what the market is doing. It is a way of accumulating and displaying data. And nothing more, nothing less. It's the interpretation that really matters. And so it's the auction market concept that matter. So coming into today, we had this 3+ day balance area that formed, and then in Globex, let me see if I can split this out. The answer is no. Okay, here we go. There we go. So the colors you see, the blue and the green, that's Globex trade. This is day session data. So really what happened is, if we were to fold this into this area, it would highlight this as that high volume node, the area of greatest value. Now, this area is the area of greatest value because of really chronological coincidence, rotation into and through this range. So this was sort of a fulcrum for price. And so today, we had Mr. Toad's wild ride in the morning, or actually into the Fed announcement, following the Fed announcement, all the machinations there. But what is most important now, a couple of things. You sort of had a false breakout, and then up here, and it looked like, and I was long, I went long. I was going to go with the break. I got stopped out and I went short, but we'll talk about that. And now we have all this conviction to the downside. So what's important? Is this high volume node important anymore? No, it's not. What is important is this last 60-minute range. And this last 60-minute range is most of the range of the day. So what should not happen now under a bearish scenario, you really shouldn't see this range retrace very deeply. And my guideline is about the 50% level. You know, you guys can put a fib retracement on your bar charts and find the 50% level, and this is a level. And that's a guideline. That's something I've learned. And this is true not only, it was true in any time frame, whether it's a 1 minute chart, a 5 minute chart, 30, 15, whatever, 6.5 minute chart, a wide range conviction bar. If it's real, you really shouldn't see your market, and it applies to other markets as well, not just the stock index futures. Really shouldn't retrace very deeply into that structure. So this is the market profile view. Now you can see the exact same thing on a cash chart. Where is my cash? What happened here? Hold on, here we go. So if I were to go down to, this is the daily, let's go to a 60-minute chart. This is the SPX. Then you have this extremely wide range here. So you probably, I would be concerned tomorrow if we come in and we're hovering in this area and we don't immediately retrace. Now, here's something else. And I told the membership this, by the way, those of you who may not be familiar, we have a membership. It's $97 a month. You can cancel at any time. It includes a live trade room. Part of the live trade room, anytime I say anything in the live trade room, I record it. And then at night, unfiltered, unedited, I send it out so that people can listen to what I said, hopefully learn something from it, and they can see the good, bad, and the ugly in what goes through a trader's mind. And it's basically a live trading webinar every single day. Also do a report every morning before the market comes out, similar to what we're doing now. Like I will do a report in the morning after Globex discussing this and using this as an example and saying, okay, we talked about this last night. This has happened. This means this, etc. So if you're interested, it's $97. You can cancel at any time. AlexanderTrading.com. Go to memberships if you're interested. So this is about the level that should not come out now. Now, also, what I think is the June lows are most definitely now in play. And I've been saying for a while, to me, the ideal long trade setup is if one or more of the indices makes a lower low, but not all of them. I guess I should say one or more does not make a new low while one or more does. And then you have a strong reversal. That's a buy signal. That's a buy signal against the low of that day if it reverses. So often you see, especially at pivot lows, you see this divergence occur among and between the indices. It happens far more often than not, especially at bottoms. Sometimes tops are coincident more often, but lows, you almost always get some sort of divergence. You had divergences at these pivot lows along the way down here, and I have marked those and pointed those out in reports and in real time in the membership. So that's what we'll be looking for. Now, I also sort of expect if this is as bearish as a lot of people are going to think it is, including myself. I mean, it's bearish until it's not. I would expect to see a gap lower in the cash session and potentially another wide range day. Now let's look at a couple of things. All right, this was Fed speak here. And then this was a big gap, but this was the cash session day. This was Fed stuff. And this is certainly Fed stuff. Now notice the conviction. This was a deeper retracement into this range. And if you look, that's probably, well, let's just put a fib thing up here and see. No, it's not the right one. Okay, so it didn't quite retrace 50%. So this certainly didn't retrace 50%. And 50% of this, while we're here, we may as well just draw it in. Well, I just about nailed it with my eyeball guess, somewhere around 38.50. So that's close enough. So that really shouldn't be retraced. These Fed events, these wide range days, have not been retraced. Even this one, and this was an extremely sharp, deep bear market thrust. It's in what we're seeing. The price action is so classically bear market type of stuff, where the rallies are just brutal and whippy, etc. And that's the nature of bear markets. You know, everybody's waiting for this relentless 20% crash in 4 days, like we have very rarely, like we had in October of 2008. Parts of 2020 were pretty relentless, but even in those cases, you have counter trend rallies that are substantial, 2.5%, 3%, 4%, 5% in a day or two, then is retraced. That is far more typical of a bear market. Bear markets are not these nice, neat progressions that bull markets tend to be, where you just grind higher day after day after day, and then you get a 1% retracement, and then it starts grinding higher day after day, and this goes on for months. So that's not the way bear markets work, which is good news and bad news. If you are a trader, it's great. As long as you don't trade a narrative, it's great. But the next substantial move appears to be to test these June lows. Now, what happens following that? I don't know. But if we get down here and we don't see confirmation within a day or so, and or we get down here, something makes a new low, and then you have this wide range up day, then that's probably an intermediate term low, and you get some sort of rally potentially as strong as the rally we got out of the mid-July low. Now, on the other hand, if we go to lower lows and then the market just sort of sits there for a while and sits there for a while, and the others begin to catch up, then you're into waterfall decline, washout type of territory. I don't do the fib game where I get projections all the way down to 1,500 or 2,000 or 2,500 or 3,000. It's a moot point. There'll be, if we're going to 2,000, there are going to be plenty of trades between here and there, long and short, that are quite catchable trades. So I don't play the drama game where I'm looking for an immediate move to 3,000 or whatever it is. The immediate move I want to see are the June lows. I want to see what happens around the June lows. And you know, who knows what happens? But I do know what I'll be looking for. What I'll be looking for is confirmation or non-confirmation among the indices. I think you can see the Dow is already, I mean, it's just a fraction from new lows. So, yeah, I mean, 2%. What was today? Today was probably more than 2%. Yeah, another day like today, and you're at new lows in the Dow. Now, let's take a look at another piece that we look at that we have to use in the stock index futures or stock indices, and that's breadth. It's NYSE breadth. And this is, I consider this pure auction market data. It's data that is generated by buying and selling among market participants. So it's not an oscillator. It's not a magic number. The indicators you see on my screen are very simple. This is a 10-day moving average of advancing issues. This is a 5-day moving average of advancing issues. And this is market breadth, NYSE advancing minus declining issues. I have never found a more accurate or objective or consistent sentiment indicator than this work. It is somewhat of a blunt instrument. You can't rote trade it. It's always dangerous to play overbought, oversold. Now, I like to use the terms extremes, and like a lot of things, just as in the case of watching the indices and the relationship of the indices at important intermediate to long-term pivot tests, or when one or more is exceeding them, it's important to keep into context this information in terms of what constitutes an extreme. Now, if we get down into this, you can see this level, this was an extreme in the 10-day moving average. And we did, within a day or two, had that ripping rally. Same thing here, you had that ripping rally. Same thing here, you had a ripping rally. Now I can go back to 2020 and show you when you didn't have the ripping rally and you were down another 5% before you had a ripping rally. So there's always that side of it. Again, this is a blunt instrument. It has to be put into the context. Everything I do and everything I would hope that you would do should be confirmed through price action. If I think the market is bottoming on a daily basis, I'm going to go to a 30-minute bar or a 60-minute bar and make price prove it before I'm jumping on board. I don't step in front of falling knives or freight trains. Breadth, as you can see, was negative today, but not that negative. So again, this gets back to what I think is the binary situation we're in now. If we're going to test the June lows and one or more of the indices, we should immediately have, like tomorrow, another negative 2,000 breadth day. And if we don't, if tomorrow opens up and we can't generate any downside momentum, we start trading halfway through this range, then I'm going to start to wonder about my working assumption, my narrative. You really, and this bear market is just, of course, all markets are like this, but it's so important not to trade a narrative. And I've been trading 38 years and I'm guilty of it. You can, and I'm not talking about simply a fundamental narrative where you think we're in a recession, you think the Fed is overshooting. That's a fundamental narrative. Well, I can be guilty of saying, okay, well, look, this is an extreme. So I think the market's going higher, and then I get blinded and I miss good trade setups to the downside because I have a technical narrative. So you really don't want a narrative, is my point. And price action should confirm any working assumption you have. So my working assumption at the moment is that this market should go lower immediately. We should see an increase, at least in the short term here, in downside momentum, meaning Brett should be negative 2,000 or lower. And if we do take out this September low in the Dow, then you want to be paying attention to see if the others follow through in short order, because if they don't, that is a divergence and it will be resolved one way or the other. Okay. Another technical piece, VIX. And I want to point out, this was the Fed day. I think this was Jackson Hole. No, this was Jackson Hole. This was some other Fed event. I can't keep up with it. There seems like there's one every other day now. But anyways, wide range day. And you can see down here, VIX on this day picked up, but not a little bit. And VIX, even as the market continued to decline, and it finally spiked here on the exact low, which was interesting. And then on the Jackson, I think this was the Jackson Hole surprise, VIX exceeded anything that we'd seen since over here in July. And it held up pretty stubbornly well. But it really didn't spike much. Now, today is interesting from a VIX perspective because we had the wide range day, and VIX is the highest it has been now since, again, well, this is the end of June. Now, VIX is one of these things, and I'm not going to get into the weeds with the option gamma stuff, but the bottom line here is we're in negative gamma. And for practical purposes, what that means is that selling will beget more selling. It sort of ends up in a loop because of the option dealer dynamics and hedging dynamics. But option dealers will generally be selling. So that's another strong catalyst, and it's another strong reason with us closing, with the market closing on its lows, to see follow through in Globex and see this gap down in the cash market. Okay, let's look at something for you. For those of you that day trade, I want to share with you. Now, I have 8 screens. I keep different time frame charts on my screens. I keep a 1 minute, 5 minute. I keep a 3 minute of all 4 of the indices. I keep a daily of all 4 of the indices, so I can maintain perspective. And I challenge you to find anything I've ever said or written that even suggests trading is easy. It's not. Trust me, I know this. I'm painfully aware of this. It's just not easy. This is a 5 minute chart. And as expected on a Fed day, it was very, very whippy. Now, I told you guys, I was sort of leaning short, especially when we tanked in here. And I got short, and then I got stopped out. And then when we got up here, I said, okay, I know this thing is going to move big one way or the other. So I went long. Now, what I'm doing there, what I did, I followed conviction. I wanted to be short. I mean, this is clearly conviction. And then I had to say, okay, something else is going on, should not retrace, violated my rule. Now, I didn't go long there. I would have been better off if I had, but I didn't. So I went long when we started. I had conviction here, so I went long in here. And then we started building this balance area, so I went short, and I'm short into the close. Now, that's not easy. I would never suggest it's easy, but you're far better. You have to have the mental flexibility to see what's going on and to react to it, regardless of what your present position is. The market, what you're looking for the market to do is either confirm or invalidate your decision. If it's confirming it, what you're looking for is an opportunity to add to your position, depending on account size, your facility with trading, et cetera. Now, another piece of my decision-making today in both instances. So Brett was, hanging around for the most part, most of the day, right? I was pretty strong. So I'm thinking, okay, the big boys are not selling this thing. And then Brett fell out of bed. We had the conviction bar, and it looked like Brett was going to go to zero. So I went short, and I would take that same trade again. I did the right thing. And then we stopped down here. Powell started speaking, and we had this wide range conviction bar up here, and I sat on my hands. And I finally got in here, and I felt good about the trade. I thought, okay, this thing is going to close at, 4,000. Well, then we started balancing. This is two-sided trade. I wanted to see one-sided trade. This was a market condition for a one-sided trade. This was a market condition from a lot of different time frames that suggested the market is not going to just churn around here, and it's going to move substantially. So I went short, that didn't work. I went long, and then I started to question, and I said this in the room at the time, that it bothered me that Brett got up here and it could not generate any more upside expansion than it did, because Brett is driven by institutions as well. And when the institutions are buying, Brett will get very strong, especially when you're coming out of what could have been, you can make a case that we were very compressed to the downside, and that the conditions were ripe for a rally. And I agree with that. However, when we got up here and Brett stopped on a dime, especially when it started declining, I figured I was wrong. So I got stopped out and stopped into a short position. I'm still short. Now, you can see Brett closed on its low, but it's not that negative yet. I do think that if I'm right, any retracement in Globex should be relatively shallow, and we should probably see a gap lower in the cash market. But I definitely know that tomorrow, if we come in and the indices aren't following through, Brett turns around and starts sloping higher, and we start, all four of the indices take out that 50% level back to the upside, then you've got to really question, do I want to be short here? So that's sort of my game plan. I'm looking for lower prices, but I know what invalidates that. And if it invalidates it, then I'll look to go long. So do you guys have any questions or comments? Happy to answer any questions. Gary says, do you normally close your position at the end of the day? Not necessarily, and let me explain that. I do day trade, and I will close trades during the trading day. But if I get in a position that I think has potential to follow through, I'm going to hold it. The best trades I have are trades that I carry overnight. The moving average on the Brett chart is a 19 exponential moving average. Seth, you ask. And Gary, you know, I'm trading multiple contracts also. So sometimes I will close part of my contracts, but on a day like today where we're breaking out of a balance area, the potential of the move is substantial from here. I am always going to carry part of my position over. Don D says TradeStation has Brett data that includes twice as many stocks as NY. Why don't you use something like that? Well, I don't use TradeStation for starters. And I have used NYSE Brett for most of my 38-year career. I know how it works. Maybe that works better. I don't know, but I don't have it. And I understand thoroughly how what I use works. So I just sort of keep it simple. There are a lot of different measures of breadth. There may be much better measures of breadth than just raw NYSE data. But I would bet that it's all extremely highly correlated. Anything else, guys? Peter, thank you, sir. I appreciate that. All right, Preston Pearden says, if I were to become a member, do you narrate throughout the day? No, I don't narrate throughout the day. I narrate, I come into the room, and I consider this, this is a great question. I don't run a stream of consciousness commentary because it's just a distraction. It's a distraction for me. It's a distraction for you. And most of the time, most market activity is noise. And, you know, trying to impress you with with my brilliance on why, every change in the bid-ask spread in the S&P mini is, I'm just not going to do it. First of all, I'm not brilliant and I don't know. Most of the time, I don't know what's going on. But I do know a lot of the time, most of the time, I do know what side of the market I don't want to be on. And occasionally, I know what side of the market I want to be on. And you will always know what those thoughts are. I come into the room, I tell people, keep people apprised of the important inflection points intraday. I try to keep people apprised of the short-term divergences among the indices that provide trade opportunities. I do show trade setups. I do update the technical situation, but I don't talk for 7 hours. There's nothing to be said. I like for people, and again, I record everything I say. And I think, I'm not sure, but I would be surprised if the live trade room total probably averages, the recording averages an hour maybe, I'm guessing. Gary says, do you list your strategy in the morning? For example, plan to go short if take out the lows the previous 3 days. Yeah, I do stuff like that. Now, sometimes I don't, the market is in a situation where I'm not real sure. And I'll say that, if I don't know what's going on, I don't hesitate to say, I don't have a clue. I do it all the time. But I don't hesitate to say, okay, if this comes out, I'm going short. And I explain why. And I update those thoughts during the trading day. And I do not hesitate to change my bias during the trading day from long to short to long to short, if that's what it takes. Don, I use eSignal. Okay. Anything else? Okay, I want to thank everyone. I know trading can wear you out. So I appreciate your time. And hopefully you found this helpful. I will get this posted. Thank you. You guys have a great evening. I'll see a lot of you guys in the morning. You guys take care.